Hey everyone, welcome back to Corporate Decoder, UBS Asset Management. America's LIC's latest SEC filing, a Form 424B3, reveals some interesting details about their ASIC long-short strategies fund LIC, and I am seeing a complexity in fees that could really impact returns. Quick note, this is not financial advice. Just my take on public filings for educational purposes. The fund is essentially a fund of funds, meaning it invests in other investment funds, and that layer of management comes with a lot of extra costs. So what are we looking at here? This filing is for the ASIC Long Short Strategies Fund LLC. It is a pretty complex investment vehicle that aims to grow your money over the long term, but how it does that is through investing in other alternative asset managers and the funds they run. Think of it like investing in a manager who then picks other managers to invest in. The main goal is capital appreciation over the long haul. It is registered as a non-diversified closed-end management investment company, which means it can focus its investments more heavily on a few things rather than spreading them out super wide. As of the 31st of March 2026, the fund had about $88.2 million in net assets. That gives you a sense of its size. Now let's talk money. They are offering a massive amount of interests, nearly $988 million. This is a big fundraising push, but here is where it gets a bit tricky. Investors buying into this might face a sales load, which is basically a fee of up to 2%. This means out of that nearly billion-dollar offering, close to $20 million could go to sales commissions. The actual money that goes into the fund to be invested is also the same near billion-dollar figure. This is because the sale price for investors is their capital contribution plus any applicable sales load. Getting in isn't cheap either. Generally, you need at least $50,000 to start. It can be lowered for some investors, but not below $25,000. Now for the big expense breakdown, the investment advisor UBS Asset Management America's LLC charges a fee. This fund pays its advisor a combined annual rate of 1.25% of the fund's net assets for management and administration. But remember, this is a fund of funds. So on top of the 1.25% the fund pays its own advisor, it also indirectly pays the fees of all the underlying investment funds it invests in. These underlying funds charge their own asset-based fees, which can range from 0.70% all the way up to 2.85%. And then there are performance fees or incentive allocations. The underlying unregistered funds can charge anywhere from 10 to a whopping 30% of their net profits. This is where things can really add up. When you put it all together, the total annual expenses for this fund are projected to be around 12.40%. That means for every $100 invested, over $12 could go towards fees every year. This is significantly higher than many traditional mutual funds. Let's crunch some numbers here. If you put in $1,000 and it earned a hypothetical 5% annual return, you would pay around $137 in expenses in the first year. Over 10 years, that hypothetical $1,000 could shrink to about $868 just from these expenses. And remember, this is before any actual investment losses. Looking at their financial highlights from 2025, the fund experienced a net investment loss ratio of 2.02% to average members' capital. This means the fund itself, before considering the fees of the underlying funds, lost a small amount of money relative to its capital that year. But when you add in all the expenses, the net expenses ratio to average members' capital was 2.21%. This shows that the fees are a significant chunk of the overall cost. However, despite these high fees, the fund actually had a strong total return in 2025, showing 19.33%. This indicates that the underlying investments performed very well, enough to overcome the significant expense drag. Now let's talk about accessing your money. This is a closed-end fund, which means you can't just redeem your shares daily like a typical mutual fund. Liquidity is provided only through limited repurchase offers, which the board decides on, likely quarterly. If too many people want to sell their shares back to the fund during a repurchase offer, the fund might not be able to buy them all back. They could buy back only a portion, or even extend the offer. This means if you need your money back, you might not get all of it, or you might have to wait. This fund is classified as non-diversified. This is a key risk factor. It means they can invest a larger portion of their assets in a limited number of issuers compared to a diversified fund, while they generally limit investments in any single underlying investment fund to less than 25%. This lack of broad diversification can lead to greater risk and volatility. They also mention the use of derivatives to hedge against currency risks, like forward currency contracts. Derivatives can be complex and risky, and if not managed perfectly, they can lead to unexpected losses. This is a big one. The incentive fees charged by the underlying investment managers can encourage them to take on riskier bets. They get paid on both realized and unrealized gains, which means they might be incentivized to make more speculative investments to boost their performance fees, even if it means higher risk for the fund. And speaking of conflicts, the filing details several. The advisor and its affiliates manage many other accounts. This could lead to situations where opportunities are allocated preferentially to other accounts, or where transactions are executed in ways that benefit certain parties over the fund itself. It is stated they aim for fair allocation, but the potential for conflict is there, especially when fees are involved. The fund intends to be treated as a partnership for tax purposes. This means investors report their share of income and losses on their own tax returns, even if no money is distributed. This can lead to what is called phantom income, where you owe taxes on money you have not actually received. Also, for tax-exempt investors, the fund's activities could generate unrelated business taxable income, or UBUBT, which could lead to unexpected tax liabilities. The limited liability company agreement details how the fund operates, including the roles of directors and members, and how capital accounts are managed. It also includes a pre-dispute arbitration clause for any controversies, meaning investors agree to resolve disputes through arbitration rather than court. In my opinion, while the fund's strong performance in 2025 is noteworthy, the sheer complexity of its fee structure and the inherent risks of a fund of funds approach are significant. The 12.40% total annual expenses, combined with the potential for underlying managers to chase speculative returns to earn higher incentive fees, are serious considerations. The limited liquidity adds another layer of risk, especially if the fund needs to sell assets to meet repurchase requests. The company's direction seems to be focused on delivering returns through active management of multiple funds. But the question is whether the high fees and complex structure consistently deliver superior net returns to investors compared to simpler, lower cost alternatives. What I'm actually looking for is consistent net alpha generation that significantly outweighs these considerable costs over the long term. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis valuable, like and subscribe for more deep dives from corporate filings.